Hi, my name is Jeff Anthony, and I'm a financial advisor at Wild Wealth Management Group. I wanted to thank everyone watching today for taking the time out of their busy schedules to hopefully provide valuable information for you and your family. Today, we're going to be kicking off a series of financial planning topics, starting with Roth IRAs. We'll be discussing what they are, differences between traditional and Roth IRAs, strategies, benefits, and why they may be a good complement to your overall portfolio. But before we dive in, I wanted to provide some background on myself and our firm. I started in the industry going back to the last recession in 2008, working with one of the largest private banks in the world. I made the transition over to the independent side with Wild Wealth Management Group in 2019 in pursuit of providing my clients a holistic, tailored approach to financial planning and investment management. About our firm, Wild Wealth Management Group is an independent boutique financial firm that provides all aspects of financial planning, some of which include asset management, estate and tax planning, insurance, college planning, just to name a few. Wild has been serving its clients for over 30 years and provides services throughout the U.S. We hope you find the topics today informative and educational, and please reach out to us if you have any questions or would like to schedule a complimentary review. With that said, let's get started. Okay, so getting back, this is, again, we're going to be going over Roth IRAs and wanted to start with the basics on what a Roth IRA is. So giving you a little bit of history on it. 1 second, there we go. Roth IRAs have become a popular retirement savings vehicle since their introduction in 1998. In 2018, approximately 22.5 million or 17.6% of U.S. households had Roth IRAs. Contributions to Roth IRAs are made on an after-tax basis, so there is no upfront tax benefits. But if certain conditions are satisfied, distributions from Roth IRAs are totally free from federal income tax. It's this potential for tax-free withdrawals that has made Roth IRAs so popular. Bear in mind that different states have different rules that apply, so make sure that you check with a tax professional. Practically anyone can open and make annual contributions to traditional IRAs. The only requirement is that you must have taxable compensation. Whether or not you can deduct your contributions, though, depends on your income, filing status, and whether you or your spouse is covered by an employer retirement plan. But even if you're not eligible to deduct your contributions, you can make a non-deductible contribution to your traditional IRA. This is important, as I'll touch upon this later. Non-deductible contributions are also called after-tax contributions. When you withdraw funds from your traditional IRA, the entire distribution is taxable, except for your after-tax contributions. That is, your deductible contributions and any IRA earnings are taxed when you withdraw from them. If you're not 59 and a half, a 10% early distribution penalty tax may apply to the taxable amount. Distributions are required once you reach age 72. With a Roth IRA, just as with a traditional IRA, you must have taxable compensation to make annual contributions. Not everyone can make annual contributions to a Roth IRA. Roth IRA contributions are phased out for individuals with higher incomes. Whether you can contribute and whether you can make a full or partial contribution depends on your modified adjusted gross income and your income tax filing status. Unlike traditional IRAs, contributions to Roth IRAs are always made with after-tax dollars. You don't get a deduction for your contributions. When you make a withdrawal from a Roth IRA, your contributions come out tax-free. And if your withdrawal is qualified, earnings in your Roth IRA are also tax-free. You aren't required to take any distributions during your lifetime. With both traditional and Roth IRAs, funds grow tax deferred, and Roth IRAs potentially tax-free. If you meet certain conditions, your withdrawals from a Roth IRA will be completely free from federal income tax. To qualify, you must satisfy a 5-year holding requirement and generally have reached the age of 59 and a half before making the withdrawal. Even if you haven't reached age 59 and a half, distributions will be tax-free if you satisfy the 5-year holding period requirement and you make a withdrawal either because of a disability or to pay certain first-time homebuyer expenses. Payments after your death are also qualified if the 5-year holding period has been satisfied. The 5-year holding period begins on January 1 of the tax year for which you first make a contribution to any Roth IRA and ends after 5 full calendar years. You have only one 5-year holding period for all of your Roth IRAs you own for calculating qualified distributions. However, Roth IRAs you inherit are subject to different rules. The 5-year holding period also applies to your beneficiaries after death. So even though your death is a qualifying event, your beneficiaries will not be able to receive tax-free distributions from your Roth IRA until the 5-year holding period has been satisfied. Spouse beneficiaries have additional options. Your spouse can roll your Roth IRA proceeds into his or her own Roth IRA. If your spouse is the sole beneficiary, your spouse can also treat your Roth IRA as his or her own. In either case, your spouse will be able to use your holding period as his or own, whichever is more favorable. That is, the 5-year holding period will begin January 1 of the tax year your spouse first established any Roth IRA, if earlier, January 1 of the year for which you first established any Roth IRA. As I've said, the 5-year holding period begins January 1st of the tax year from which you first established any Roth IRA. Remember that generally you have until April 15th to make any additional contributions or annual contribution to your IRA for the previous tax year. So, for example, if you make your first contribution to a Roth IRA on April 15th of 2020 and you designate that contribution for the 2019 tax year, the 5-year holding period begins January 1st of 2019. Now let's look at some specific examples on how qualified distribution rules work. In this example, assume you're 60 years old when you set up your first Roth IRA on December 31st, 2020 by converting a traditional IRA to a Roth. To have tax-free qualified distributions, you must satisfy the 5-year holding period and have a qualifying event. You already have a qualifying event since you are 59 and a half. You will be entitled to tax-free distributions after the end of the 5-year holding period. The 5-year holding period begins January 1st, 2020, the first day of the tax year in which you establish the Roth IRA. The 5-year holding period ends December 31st, 2024. You will be able to receive tax-free distributions from the Roth IRA and any Roth IRA you subsequently establish after that date. Note that in this example, you get credit for all of 2020, even though you set up your Roth IRA the last day of the year. Now, assume you're 35 years old and you set up a Roth IRA on June 1st, 2020 by making a rollover from your 401k plan to your Roth account. To have tax-free qualified distributions, you have to satisfy the 5-year holding period and have a qualifying event. The 5-year holding period begins January 1st, 2020, and the first day of the tax year in which you establish the Roth IRA. The 5-year holding period ends December 31st, 2024. Even though you've satisfied your 5-year holding period on December 31st, 2024, you won't be able to receive tax-free qualified distributions until you have a qualifying event after that date. In general, you won't be able to take qualified withdrawals until 2044 when you attain the age of 59 and a half. But you may be eligible for qualified withdrawals earlier if you become disabled or have a eligible first-time homebuyer expense. In this example, assume you inherit a Roth IRA from your mother in 2020. Your mother established her first Roth IRA in 2017 by making a regular annual contribution. To have a tax-free qualified distribution, you must have a qualifying event and satisfy the 5-year holding period. Your mother's death is the qualifying event. The 5-year holding period begins January 1, 2017 and ends December 31st, 2021. So you'll be entitled to tax-free distributions at any time after December 31st, 2021. If you take a distribution from your Roth IRA, but you haven't met the 5-year holding period or hasn't been a qualifying event, then your distribution is non-qualified. But even if non-qualified distributions from a Roth get special tax treatment. Since your own Roth contributions were made on an after-tax basis, you can withdraw those contributions tax-free at any time. Plus, you get all of the contributions back first before you're deemed to be withdrawing any taxable earnings. This is in contrast to traditional IRAs, where each distribution is deemed to consist of pro rata amounts of taxable and non-taxable dollars. Of course, any earnings you withdraw will be subject to income tax, and if you're under the age of 59 and a half, the additional 10% early distribution penalty tax, unless an exception applies. So now that we've covered how Roth IRAs work, let's take a look at the 3 primary ways to fund Roth IRAs. The first is by making regular annual contributions if you qualify based on your earnings. The second is by converting a traditional IRA to a Roth IRA. The third way is by rolling over an eligible distribution from an employer plan, like a 401k, to a Roth IRA. Let's take a closer look at each one of these options in greater detail. The first way to fund a Roth IRA is simply by making annual contributions to the account. You can contribute up to $6,000 to a traditional IRA or Roth IRA, or to a combination of both in 2020. The limit is $7,000 if you're age 50 or older. But your ability to make an annual contribution to a Roth depends on your earnings, specifically the amount of your modified adjusted gross income. So if you're a high income earner, your ability to make annual contributions to a Roth IRA may still be reduced or even eliminated. If you find yourself unable to make a regular contribution to a Roth IRA due to these income limits, there's another strategy that may be appropriate for you, which we will look at in a few moments. Now let's look at the second way of funding a Roth IRA, a conversion, which allows you to turn your traditional IRA into a Roth IRA. When you convert your traditional IRA to a Roth IRA, you are taxed as if you took a withdrawal equal to the amount of the conversion. So by converting, you accelerate the taxation of your traditional IRA. Why would you want to do this? Again, as I discussed earlier, your trade-off paying taxes now with the hope and expectation that later distributions from your Roth IRA will be qualified and therefore tax-free. When I talk about conversions, the term traditional IRA also includes SEP IRA and simple IRAs. You can convert these to Roth IRAs as well, but for simple IRAs, you'll have to satisfy the 2-year waiting period before you can convert to a Roth. You cannot, however, convert SEP or simple IRAs that you've inherited. So that's a key point. You can convert amounts from a traditional IRA into a Roth IRA in 3 ways. You can make a rollover. You receive a distribution from your traditional IRA and then roll it over to a Roth IRA within 60 days of the distribution. You can make a trustee-to-trustee transfer. You direct the trustee of the traditional IRA to transfer an amount from your traditional IRA to the Roth IRA. Third, you can make a same trustee transfer. If the trustee of your traditional IRA also maintains your Roth IRA, you can direct the trustee to simply transfer the amount of your traditional IRA to your Roth IRA, or redesignate your traditional IRA as a Roth IRA. As I've said, when you make a conversion, you're taxed as if you made a withdrawal from your traditional IRA. But there's one important difference. The 10% early with distribution penalty doesn't apply to Roth conversions, even if you haven't obtained the age of 59.5. But be careful. If you make a non-qualified withdrawal of converted funds from your Roth IRA within 5 years after a conversion, the IRS will recapture that early distribution penalty unless you're 59.5 or another exception applies. If you've only made deductible contributions to your traditional IRA, then the tax calculations is easy. The entire amount you convert will be subject to federal income tax. But if you've made any non-deductible contributions, that is after-tax contributions to your traditional IRA, the calculation is a little bit more complicated. If you've made non-deductible contributions to your traditional IRA, then at any time you take a distribution, your withdrawal is treated as a pro rata amount of taxable and non-taxable dollars. Since conversions are taxed the same as withdrawals, the same rule applies. If you've made after-tax contributions to your traditional IRA, part of your conversion will be taxable and part will not be taxable. This means that you can't convert just the non-taxable portion of your traditional IRA in order to wind up with a tax-free conversion. Moreover, when you take a withdrawal from any traditional IRA you own, you're required to aggregate that IRA with all other traditional IRAs you own, including any SEP or simple IRAs, when you calculate the taxable and non-taxable portion of your withdrawal. This applies to conversions as well. So you can't just transfer all of your non-taxable funds to a separate IRA and then convert that one to a Roth to avoid conversion taxes. Before 2010, you weren't able to convert a traditional IRA to a Roth IRA if your income exceeded $100,000 or were married and filed separate federal income taxes. Thanks to a subsequent change in federal law, anyone can now convert a traditional IRA to a Roth without regards to income limits or tax status. There is one important exception. If you inherit a traditional IRA, you cannot convert that inherited IRA to a Roth. However, special rules apply for spouse beneficiaries. If you are a surviving spouse and you inherit a traditional IRA, you can roll those funds into your own traditional IRA and then make a Roth conversion. If you are a surviving spouse and sole beneficiary, you can also treat the inherited IRA as your own and then make a conversion. Now we'll revisit an earlier point we brought up. What if you'd like to contribute to a Roth IRA, but your adjusted gross income exceeds the current limits? That's where a backdoor Roth IRA, a Roth conversion strategy, comes into play. This is how it works. Anyone with earned income can make a non-deductible contribution to a traditional IRA, regardless of income, marital status, or participation in an employer retirement plan. The only requirement is that you have compensation for that year at least equal to the amount of your contribution. And as we well know, virtually anybody can convert a traditional IRA to a Roth under current law. So you would want to make your annual contribution initially to a traditional IRA, then immediately convert it to from traditional to a Roth. But remember, you'll need to aggregate all of your traditional IRAs when you calculate the taxable portion of the conversion. The final method of rolling a Roth or funding a Roth IRA is through a rollover from an employer plan like a 401k. These rollovers are also commonly called conversions and are subject to many of the same rules as traditional IRAs to Roth conversions. When you receive a distribution from your 401k or other employer plan, your employer is required to tell you whether the distribution is eligible to be rolled over. If it is, you'll have the option of rolling all or part of that distribution to an IRA, Roth, or traditional. If you roll the distribution over to a Roth IRA, the amount you roll over, except for any after-tax contributions you've made, will be subject to federal income taxes. Anyone can roll over funds to a Roth IRA regardless of income limits or marital status. Even non-spouse beneficiaries can roll over inherited employer dollars other than inherited SEP and simple IRAs to a Roth IRA, but only in a direct rollover. Rollovers from employer plans can be complicated and can have serious tax implications, so make sure you understand all of your options, including any fees and penalties that may apply and other special tax rules that may be available to you before you take action. So, is a Roth IRA right for you? The answer is a complicated one and depends on your particular situation and goals. The following are some typical reasons for choosing a Roth. A Roth IRA may make sense if you believe that you're in a higher tax bracket in the future when you will be taking distributions. Conversely, a Roth IRA may be unwise if you believe you'll be in a lower tax bracket when you retire. However, tax rates are just one factor to consider. As discussed, qualified distributions are tax-free. This means in the future you can supplement any taxable income you have with tax-free income that won't impact taxation of your Social Security benefits or affect any of the benefits that are keyed to your adjusted gross income. You're required to start taking distributions from a traditional IRA when you turn 72. But with Roth IRAs, you never have to take a withdrawal. This can allow your IRA assets to enjoy the benefit of tax-free compounding for a longer period of time. And because you aren't required to take distributions, you potentially leave more dollars income tax-free to your heirs, especially if you don't need the Roth IRA assets to fund your retirement. So some potential issues you might run into. Some factors that may argue against the Roth IRA include the following. If you expect to be in a lower tax bracket in the future when you begin taking distributions, then a Roth IRA may not be the appropriate choice, particularly if you plan to convert traditional IRA assets to a Roth IRA. As I discussed earlier, you'll have to pay federal income taxes on all or part of the amount that you convert. This may raise your current marginal tax rate, increase the tax you pay on other items of income like Social Security, and possibly impact other AGI-related tax benefits. If you have to use IRA dollars to pay for the conversion, the benefits of converting to a Roth IRA are substantially reduced. Using IRA dollars to pay the tax reduces the amount of funds in your IRA, potentially jeopardizing your retirement goals. In addition, the IRA funds to pay the tax may themselves be subject to federal income tax and a premature distribution tax. If you'll need to use the funds before you're eligible for tax-free qualified distributions, any earnings you withdraw will be subject to income tax and penalties. In addition, if you convert, the IRS may recapture all or part of any penalty tax you should have paid if you make a withdrawal within the 5 years of conversion. One of the main reasons to consider contributing to a Roth IRA is that qualified distributions are completely tax-free. However, some experts are skeptical that the way this will always remain the case, given the uncertain status of Social Security and the projected lost revenue, federal revenue attributed to Roth IRAs. Although most states follow the federal tax treatment of Roth IRAs, you should check with your tax professional regarding the tax treatment of Roth IRAs in your particular state. It is important to weigh all of the factors, both pros and cons, to determine if a Roth IRA is right for you. Small steps can enhance your financial life one day at a time, and we would love to help you out with that path towards retirement. Questions are always welcome. We would love to help you out, and I hope you found this very informative. And if you would like to get more information or take a deeper dive into Roth or any other piece of your financial future, we would love to help you out. Thanks again for taking the time to share with us today, and we will hopefully talk to you soon. Thank you.